to go to the conference, UBank conference on sports betting. Did anyone get a chance to attend that? Harshit, have you got a summary that you could give the class on what was interesting to you that you didn't know before then?
Yeah, I like a couple of talks. There was one about the corruption and sports gambling by Declan Hill, which was quite an interesting talk. He talked about the size of the betting market and the amount of corruption where like these people, they control the entire soccer team of some South American countries. So that that was pretty interesting for me. Also, there was another talk about analytics in soccer and how like teams like Liverpool are using the analytics, sports analytics, to like make informed decisions about what players they need. Like traditionally, goals are very rarely scored in soccer, so people tend to overvalue the strikers who score goals, and that's why if you go to the look at the most highest valued players in soccer, they are usually strikers or other players. But if you look at statistics, a goal saved in a game has more value than a goal scored in a soccer game. So by that analysis, the goalkeepers and defenders are also very valuable, and teams are realizing that. For instance, like Liverpool, which has been very successful in the last 2 years, they made like two purchases where they bought a defender and a goalkeeper, which were like at that time the record highest amount paid for a goalkeeper and a defender. And since that has strengthened their team as well. I like these couple of talks.
If it makes you number one, it's hard to argue with it.
Yeah, they won the Champions League and Premier League.
Well, thank you for that very good recollection from the conference. It was quite a busy time, but I think we talked about this a little bit before. So there will be recordings will be released if you're interested. I certainly didn't know that much about gambling, so I found it quite mind-boggling. The trading contest, as far as who is coming in first, second, and third place, we don't have the exact numbers right now. I still have some questions from a couple of the teams on how they got out of their positions, and we were going to kind of work that out this morning, but we're not going to do that because we have our final project presentation. So we will figure that out, and I will post the results. I will tell you, ballpark, we're about minus 33K for the year. So we're essentially flat. Okay, there were some good trades and not so good trades. I think last year the total gain was 3 million, and so, but this is better than losing big time, and it's very instructive to see what the actual positions did. But well, maybe I'll give you preliminary peek here so you can kind of see what they are, because we're not going to get a chance to talk about these before we have our happy hour, which we haven't scheduled our happy hour. But this is our trade sheet. And so here you see we have four groups. We have four groups. And so group 0 was your instructor, and he had these positions on, and the total gain and loss of those was 11,000. So I didn't make a ton on my positions. Remember, I had the February 60 GameStop, which miraculously pulled back to out of the money. And that really worked out. I'm glad we sold it when we did on the 11th, because by the 16th of February, it was back up over 300 again. So we really lucked out on that one. And then the rest of them were simply based on the S&P. And so all of those expired. So the total of the S&P options was 4,000. Because they were each spread. This one was supposed to make 13 and lose 10, and make 19 and lose 18. So overall, you come out ahead on these spreads if that's the way you're doing it. And so we made 4 there and 7 there. So, and then group 1 did a lot of work. They did puts on PSTH. Now, what I assumed on the exit date, they had 35 puts. So I assumed that this was on the 19th when they got out of that. The stock was at the put value was 940. In other words, it had gotten worse, and then this 30 had a value of 440, and so you can see this position had a loss of 840, and so you just have to go through here and you have to get the prices, the closing prices, and then close these out here. These, for instance, Tiger expired, Taiwan Semiconductor expired. What they did was they bought these 100 calls on Taiwan to give us sort of a long position in the stock. And so I don't know what the group did to get rid of that position if they sold at the close on the 19th. So that's why I got to find out from group one what they did. Same with what they did with the SPY. They bought the January 350 call for a long position. Same with this one. They bought the ARC December 74 as a call position. But group one, well, let's just see how group one did. So this is a total cost basis notional, so that's going to be low. And so group one actually, without closing out those other positions, had a small loss of $18,000. Well, 18% loss, I guess you could call that an 18% loss. Group two had a smaller number of trades. They just had the Tesla, Boingo, Nike, and the Cents and the Apple calls, and you can kind of see how those worked out. And group three, these were pretty easy to understand, but I need to go through here and make sure that they didn't get out of these positions earlier. And if I put the wrong strategy on this sheet, I apologize. That's because I have not carefully reviewed all. I think we got like 10 submissions on this. I'm not sure how we got so many submissions, but anyway, we'll update the sheet and send it around and then we'll know what it is. But bottom line is, you see here, we're about minus 33 when everybody comes in. So overall, it was not a really super great year, but at least the numbers on the downside were relatively small. Of course, we're talking about 100 grand account, so so this is a 4.8% loss. And then remember, this is just 3 months. So anyway, so I'm happy with the trading contest, but I've got some homework to do because I have to update those trade sheets and make sure that, and if I have further questions, I will ask you, and because we want to clear this out. So with no further ado, let's hear from group number one, and this is Sukriti and Will Mundy and Derek Wu, Alex Xiong, and Bosco Shu. And we're going to be looking at asset class returns and different stocks that track physical commodities.
Right. Thanks, everyone. Can everyone see my screen?
Yes, it looks good.
Sounds good.
Great. Hi, everyone. Today we'll be presenting on a historical analysis on asset classes return. And this presentation is by myself, Sukriti, Derek, Alex, and Bosca. Next slide. So first, in the table of contents, I'll first be going through a quick introduction. Then I'll pass it on to Alex for the methodology. Then we'll walk through some of the returns and an analysis of that. And finally, we'll look at a time series analysis. Next slide. All right, so our idea for this presentation is that we are going to explore the returns on varied asset classes over the past 12 years. The asset classes that we'll be exploring are the small and large cap US equities, REITs, commodities, fixed income, cash, and private equity. For each of these different asset classes, we've found some proxies for these asset classes, and we'll be analyzing the returns on these various proxies in order to determine the best performing and worst performing asset classes over the past 12 years.
So for the methodology, next slide. Bosco, next slide. For data collection, what we did was we pulled data from CRSP, Russell, and Yahoo Finance. Returns, we plotted the yearly percentage and the terminal values. And for time series, we conducted ARCH and GARCH modeling. Next slide. In terms of data collection, we use the JP Morgan classification for small cap and large cap, which represented Russell 2000 and S&P 500 respectively. Some specific ones that we want to point out are for real estate, we use the North American Retail Equity Index. For cash, we use Barclays 1 to 3 months Treasury bill, and for private equity, we used Invesco's Global Private Equity Index.
Hey, could I just interrupt with something? When Lynn Lewis was doing her REIT thing, she did that report for the NAREIT, which is the National Association of Real Estate Investment Trusts. And that's what she was called upon to do for that volatility report. Sorry.
No. Okay, so next for returns. Next slide. So this was the asset class return plot for 2007 to 2020. As we can see, there's some similar trends, I guess. What we can glean from this graph is that the small cap, large cap, as well as the REIT followed similar trends, while cash remained constant. In the next slide, where we can see for terminal values, we see that for the three that were mentioned before, they outperformed cash, whereas the other three, commodities, fixed income, and private equity, all performed worse than cash. Next slide.
All right, so now we'll be diving a little bit further into each of the individual asset classes, and we'll start with small cap equities. So it's just important to know that small cap equities can be seen as slightly riskier investment vehicles than some of the other asset classes that we have. And so we see that they have a relatively similar trend to that of large cap equities and REITs in the past, especially in the two plots that we showed above. But there's a few key years we can analyze. So as expected in 2008 with the financial crisis, we do see a negative impact on the return rates for small cap equities, and it takes them about 2 years to rebound to pre-crisis levels. But then in 2010 and 2011, we see the peak of the European debt crisis, and investors start straying away from more riskier assets such as small cap equities. By 2012 and 2013, as the European debt crisis begins to tone down and the signs of recovery after the 2008 crisis persist, investors have growing appetites for risk, and this leads to further investment in small cap equities and an increase in the terminal value plot. The next point we can note is in 2016, with the election of Donald Trump, we see a positive impact on the returns for small cap equities, as investors might have believed that a Trump administration would be beneficial for more domestically based small cap firms. And this lasts until about 2018, when trade war tensions start to heighten, and small cap stocks definitely take a bit of a hit here. Small cap stocks might actually be more vulnerable to trade tensions because of the relatively lower pricing power that they have in the face of higher tariffs. And so then in 2019 and 2020, though, at least in the plots earlier in the presentation, we see this begin to stabilize. Next
So
slide.
Creedy, could you go back to the previous slide? Yes, this one. Now, are you saying that this chart here somehow tells the story on the right-hand side of this slide too, somehow?
Yes, the story on the right-hand side is from the annual returns plot and the terminal value plot in this 2 slides above, where we saw more of a comprehensive, like.
Okay, you didn't try to correlate returns with any one of those particular eras, regions in time. Like that whole area, 2012 to 2013, the little jiggles look pretty uniform.
Yeah, so I think the terminal value plot does show a little bit more of the fluctuations that we mentioned there. But, yeah.
Okay, sorry, go on.
So on the next one, in large cap equities, we found very similar trends to the small cap equities, albeit there were the key differences in the scale of the downtrends and recoveries. So in 2008, we saw that the rate of return for large cap equities fell lower than small cap equities. However, in 2010 and 2012, again, referring back to when Scree mentioned in 2010 to 11, the European debt crisis, and then the recovery in 2012, the rate of return was actually recovered higher than small cap equities. And so the scale of large cap equities, their rate of return was either much less or much greater, which means that large cap equities are significantly more risky, but also offer much more of a reward. Now, in 2016, we actually found little to no difference from small cap equities in terms of large cap equities' rise. But in 2019, during that economic bull run, we found that the rate of return rose much higher than small cap equities. However, they face similar performance to REITs and private equity. Now, large cap equities end up with the highest terminal value at the end of the time period. Yavaska, if you want to go back to the terminal value chart. Yeah, and so we can see that the terminal value of large cap equities actually ends higher than REITs and much higher than small cap equities and the other asset classes, indicating that large cap equities, again, while they are significantly more risky, they also do offer a greater rate of return and a greater reward at the end, especially at the end of this 12-year economic bull run. Now moving on to REITs. We found that REITs, based on the index that we tracked as our proxy, typically correlated with large and small cap performance, although there are slight differences in both 2011 and 2013. Again, in 2008, the drop in rate of return was roughly equivalent to that of large cap equities. So again, indicating the significant risk of REITs, especially given that 2008, there was a housing bubble. And so REITs would suffer from that issue. Now, in 2011, we actually an opposite trend for REITs compared to the equities. This is largely because REITs in the Americas, which our proxy tracked, were unaffected by the European debt crisis, and therefore the REIT index actually outperformed the S&P 500 in that year. Now, in 2013, we actually saw a very interesting trend where large cap and small cap equities rose a lot. However, REITs fell a lot, especially towards the end of the year. The primary factor behind this was that there was a threat of rising rates by the Fed, and there were also changes to quantitative easing, which meant that the Federal Reserve stopped buying REITs, and therefore less capital was pouring into REITs. As a result, a lot of investors got scared, and then they pulled their money out of REITs, causing essentially a domino effect and causing losses to be much greater than they otherwise should have been. However, this event led to, in 2014, REITs actually surged once more and outperformed the S&P 500 by quite a few points in terms of the percentage. And so REITs in that year were a much better investment vehicle than any other asset class. Again, in 2016, the REITs actually underperformed large and small cap equities. So the election of Donald Trump did not help REITs that much in that regard. However, in 2019, REITs performed in line with large cap and private equity, which indicates that REITs significantly benefited from the economic bull run of that year. And again, the final terminal value of REITs was slightly below that of large cap stocks, which indicates that REITs over a long time horizon are a good investment. Historically speaking, REITs have actually been the most consistent high performing asset class. And so this was an interesting tidbit for us to find that the final terminal value was actually lower than large cap equities, as that was out of line with the longer term historical norm. I'll pass it on to Security for Commodities.
Well, so the main thing that we can see when we're analyzing the returns for commodities is that these return rates tend to run opposite to that of large cap equities. And so we have two key points to analyze here. Is that first one is in 2008, while as Will and I mentioned earlier, a lot of the other asset classes are declining in value, we see commodities actually rising in the return rate. This is partially due to 2 points. First, we see growing industrial demand for commodities in Brazil and China. And also during the 2008 financial crisis, investors might have found commodities to be a safer bet than equities. And then secondly, in 2016, we see a large plunge in the return rate for commodities. And a lot of people speculate that this is because of an economic slowdown in countries like China, which led to a decrease in demand, which is met with an oversupply for commodities. And together, this negatively impacted commodity returns.
How long is that peak down? Is that one tick or two or three?
Bosco, do you have
sticks? Or, sorry.
Yes, I think it's based on the monthly return data. So for the whole month, the value dips.
Okay, so that's just 1 month time tick.
Yes.
Okay, thank you.
All right, and then moving on to the fixed income returns, the terminal value plot that we showed earlier on in the presentation does stay fairly consistent, but as you can see, the annual returns show some more fluctuations. In 2008, as our index was based on more high yield bonds, we do see an expected drop in the rate of return as investors stay away from slightly riskier investment vehicles. And Then in 2011 and 12, however, we do see a slight uptick in the rate of return, perhaps because fixed income as a whole was seen as a safer investment opportunity during the European debt crisis. In 2016, we see Trump's election and his platform pushing for higher growth and domestic spending, which could have driven inflation prospects, driving investors to riskier assets. So if we go back up to the annual returns plot at the beginning of the presentation, you'll see that there was actually a bit of a decline in the rate of return. And then in 2018 and 19, however, with trade war tensions heightening, we once again see investors coming back to fixed income vehicles as a safer investment option. Now I'll pass it over to Alex.
So for cash, we do see dips during 2008. So that's, again, as Creedy and Will mentioned, the housing crisis. But as with cash being a fairly consistent investment vehicle, the drop was only roughly 1%, and it rebounded very nicely. And if we, Bosco, if you could go back to the terminal value plot, we do see that there is a slight increase in the cash, very marginal, but something that we just wanted to note. So if you go back to the cash presentation slide. So what we concluded from this is cash is a fairly consistent investment vehicle and will likely remain as such. Just to note again, our proxy was 1 to 3 month treasury bills. And then next slide, please. So for private equity, what we wanted to talk about was that there are fluctuations, as we see in this return percentage graph. The terminal value plot back in from the previous slides was private equity was one of the assets that was that had a significant drop compared to cash. And this is most likely, we attributed this fact to the fact that we used an ETF, the Invesco Invesco Global Private Equity Index ETF. And this is definitely not representative of private equity as a whole. And so future exploration would be to create a basket of other private equity indexes in order to gain a more representative view of this asset class. Next slide.
Right, so now we're trying to look at things from a more statistical viewpoint. So we're gonna try to fit time series models on our daily returns for the different asset classes that we just talked about. So basically the most relevant model here that we're trying to fit is the Arch and Garch model. And some of the key features of this model is that, well, actually the key feature of this model is that it captures one of the key features in financial time series, which is the idea of volatility clustering. What that means is across time, data points with high volatility are sort of clustered together. So based on this model, as you can see from the conditional variance, if the magnitude of the return series from the previous M steps are high when aggregated, then that means that the variance for the return series on this step right now will also be high. So that means that this model will capture this feature of volatility clustering. And one example of this Garch model would be the Garch 1.0 model, which is shown on the right. So the return series is this variance times this white noise process. And then the variance is constant plus a constant times the square root of the previous return. So, but that's just one example. But for Garch model in general, if you look at the variance component, which is the second line, we can, so for example, if we want to do a Garch 1.1 model, then we can totally also make the variance depend also on a past copy of variance itself. So not only on the past return. So that could be where it's flexible. And then for the return process, you can also choose other models like ARMA and stuff like that to modify the return process. Next slide, please. So for the cash returns series, we examined the ACF and PACF plot of the return series, which is not shown here, but that's basically what we do when we're trying to figure out what kind of model to fit. And the conclusion that we drew was that the best family of models was the GARCH model. And so then we played around with the parameters and tried out different fits and see which one worked the best. And we concluded that the ARMA 11-GARCH22 model would be the best fit. So if you look at on the top right, you look at the autocorrelation of the standardized residuals, you can see that after the model is fitted, basically the structure of the time series has been captured because there's now no correlation among barely any correlation among the residuals. And the Portmanteau test shows basically the same story. The model is a good fit. And once we've established that this model is a good fit, we use this model to forecast. And if you look at the bottom right plot, that's the forecast with the prediction intervals. And you can see there's increasing volatility toward the end of the prediction. Next slide, please. We did the same thing with the other return series. As you can see, some of the models that we fit are ARMA 2.20 model dash ARMA 2.0 dash GARCH22 model, and shown here are also the prediction with the prediction intervals. Next slide, please. Same thing here, basically the same story as the last slide, and the results are shown here. And for the commodities return, we did what we usually did. So we checked the ACF and PACF, concluded that the best model fit would probably be a GARCH model. And but then we see something weird on the graph on the left here, because there's this one spike that's not really captured by the conditional standard deviation. So even though this is judging from the ACF and PACF, this would be a good model, we've decided that this is not good enough fit. So we are going to try something else, which is the state space model. And I'm gonna hand it over to Bosco to talk about the state space model for the commodities return series.
Yeah, thank you, Derek. So the basic underlying idea behind the state space model is of our time series is formatted as a observation to our potential or unobserved state process underlying that. So as can be seen from this equation, we have YT, which is the observation process, and it's given the underlying state. And also we have the state process of which is correlated, as we can see here. The state at time t is correlated to the last t-1 state. So that is the underlying assumptions about this model. And we think we can use that to detrend the series and to discover something. Right, so based on the commodities return data, we break down the model into a trend formula and the seasonal formula of 12 months. So this generally separates the seasonality from the trend. And we can see over each year, there's significant cycle within the returns for commodities, and the trend has been declining over time. And then we applied the Kalman filter to the commodities return. And so this filter is to figure out the trend of the model based on the previous observations. So as we can see here, our trend was volatile at the beginning, which is also signified by the observations and has higher confidence interval. But right after that, it just narrows down and become more constant. Then we forecast the returns on the 95% prediction interval. And we used a seasonal components of 12 months. So basically it just iterates itself year over year. And we project the future cycle for over 2 years. So this is our model for commodities return, which captures a portion of seasonality. And we really appreciate this feature. So
sorry, Bosco, could you just quickly tell us what the commodities data comes from? Is it a basket or is it an index or what is it?
It's from the Bloomberg Commodity Index.
Okay, is that a GSCI or the other one, the CRB index? Or
no, I think it's from Bloomberg's internal sources.
Okay, so they have all kinds of data, so that's good.
Got you. So it's a composite of various commodities combined.
I'll bet you can find out.
Yep, sounds good. So on the next step, we think we're going to further improve the performance of our models. by applying increased focus on geographic analysis by training the model on training and testing data to better assess more model performance based on either test statistics for either normality assumptions or other residual assumptions, as well as determine the information criteria such as AIC, BIC to further optimize our future prediction results. And we can even expand these analysis to more indices or more asset classes index to see if there's like a universal model that fits. And moreover, we want to explore more in depth about predicting future returns based on different portfolios of asset classes. So right now what we're doing is we're basically projecting or fitting a statistical model on each of the asset classes. And we're interested in how portfolio would perform just corresponding to these returns. And also for a state-based model, I think generally for commodities, it has a 10 to 20 year cycle, while we also capture 12 years of data. So maybe we should gather data on a longer time horizon in order to reflect that full cycle and see what we can do out of that. Last but not least, we'll continue our analysis into different asset classes by applying more complex data sources. For example, in REIT and PE data, we use like a single index, and specifically PE, we use the Investco's private equity general index. And this is actually not representative of the whole picture because the PE return was pretty high. And that index return was kind of low compared to the actual PE return by Cambridge Associates. But unfortunately, we have to pay to get access to that. So we use the available data. Right, and another thing is we can use multiple proxies for large cap equities and then compare the results. This is the same principle as searching for better indices for our analysis. Right, so I think that's the end of our presentation. I'm gonna, this is the list of reference we used for our data, and I'm gonna open to any questions you may have. Thank you.
Any questions for group one? You brought up the getting more data, Bosco. If you had gotten data back to 1970, do you think your terminal value plots would have changed?
Yes, definitely. So our starting date is actually 2008, and this is during the financial crisis where everything was suddenly undervalued. And at this time, I think the terminal value generally like has kind of higher return on asset, but it really depends on the starting year. So if I were to do like 1970, maybe like right now, the terminal value is even higher. We have to adjust for inflation on that.
Well, if there are no more questions, I think this group did a super job. I love the way they went when they found that the ARMA models didn't really do too much on the commodities. They went to this other model, and that's a good example of investigation. And you can keep going down different trails trying to find perfect models, but that's a reasonable place to go, and I appreciate it. So thank you. Okay, let's see. We have the SARIMA predicted returns of portfolio schemes. Jason Kashu and Chia and Jingran and Mungting and Harshet. So who would like to start out?
I'm getting there. Let me show my screen. Can you guys see it? Can I see my screen?
Yes.
Oh my bad. 1 second, guys. My computer's being weird. All right, can you guys see it now, or is it black?
It says loading.
Okay, there it goes.
There we go. That looks nice.
Thanks. Okay, so we did a time series to forecast on analyzing the portfolio's returns, and so we used SARIMA was that the time series technique to forecast future returns. There were 4 common portfolios construction strategies, such as, and the 4 main ones were max median, max max, max mean, and minimum volatility. And ARIMA is most often used for forecasting, but However, it does fail to account for seasonality in the stock market. The data that we used was from 2015, and we used this data to try to predict the future returns for 2015 to 2020, and we tried to find the best model to forecast the trend on 2021. Oh, excuse me. We used the auto SARIMA to choose the best model for each portfolio strategy, and then we used the SARIMA 4 to forecast the trend for 5 years, and it was able to compare the predicted returns with the annual returns, and we also used it for forecasting 1 month return for January 2021.
So before we dive into analyzing these 4 portfolio construction strategies, so as Jason explained, we are looking at 4 portfolio construction strategy, and one way to compare them is looking at the total return on the strategies, or the CAGR. But another metric which accounts for the volatility of returns as well as the Sharpe ratio. It's defined as we take the CAGR of the portfolio, subtract the risk-free rate, and divide by the standard deviation of returns. So before we start analyzing the returns of the different portfolio strategies, I wanted to recall this because we use Sharpe ratio to compare the strategies. Now we'll look at the 4 portfolio strategy. And before we start diving into that, we need to determine the right size. What is the right portfolio size for each strategy? And so Mengten will take over now and discuss that.
First strategy is max median. The one strategy is composed of companies with highest median daily return in the past year. And we compare six size using their yearly terminal value from 1970 to 2020. And in the graph, we can see in the orange line, the terminal value means that in 1970, if we invest $1, and at the end of 2020, we will earn $6. And from the graph, it is obvious that size 10 have the highest yearly terminal value. And in the size 5, it has the lowest yearly terminal value. And we will further compare six size using the table. In the next slide, next please. In the next slide, there are 4 values for each size, and we can see for size 10, it also has the highest CAGR value, but the standard deviation is also high. And we can see the size 30, we can see it has the lowest standard deviation and also the high Sharpe ratio. So if we consider the portfolio volatility, the size 30 could also be the good portfolio size for the max median strategy. Next, please.
Mengten, was this for 2015? 2015, you were getting a 4% risk-free rate. Where were you getting a 4% risk-free rate from?
Harshit did this part.
So this this is the Sharpe ratio for the returns over the last 40 years, starting from
oh, that's okay. Then I'll buy that. I'll buy that.
So this is like we took the annual risk-free rate returns on the treasury bonds, and we took the CAGR throughout the last 50 years, starting from 1950. And that CAGR starting from 1970 of the treasury bond comes out to be around this.
And the next strategy is max mean. One portfolio is composed of companies with highest mean daily return in the past year. And we also compare six sizes using their yearly terminal value from 1970 to 2020. And from the graph, the size 30 has the highest yearly terminal value. But we can see the yellow line, the size 25 is very close to the size 30. So we will further compare two size using the table. Next, please. In the table, compared to size 25, size 30 have higher CAGR, lower standard deviation, and higher Sharpe ratio. So the size 30 could be the best portfolio size for the max min strategy. And Jiang will introduce the other two strategies.
Yeah, then we explore the effect of portfolio size on max strategy from 1970 to 2020. And again, we focus on 6 portfolio sizes, size 5, 10, 15, 20, 25, and 30. And from this plot, we can see that size 30 has the highest terminal value and size 5 has the lowest terminal value. Next, please. And then we calculated the CAGR, the standard deviation, and the Sharpe ratio for all 6 portfolio sizes. And we can see that from the table, size 30 has the highest CAGR, the lowest standard deviation, and the highest Sharpe ratio. So this validates our conclusion from the previous plot that the size 30 is the best portfolio size for max strategy. And then we explore the minimum volatility strategy. And from this plot, we can see that size 20 is slightly higher than the rest of the size, but in general, they are all very similar. So we have to calculate the CAGR standard deviation and the Sharpe ratio to further see which one is the best. Next, please. And from this table, we can see that all 6 portfolio sizes have very similar standard deviation. They're all around 0.15, but size 20 has a higher CAGR and higher Sharpe ratio. So we can conclude that size 20 is the best portfolio size for the minimum volatility strategy. Next, please.
Okay, so now we end this analysis by just looking at all the 4 strategies at once. So in each of the 4 strategies, we found the right size for min volatility. It's 20, max it's 30, max mean it's 30, and max median is 10. Now so we have in each category, we have picked our best. And now amongst these 4 best strategies, we can see that max mean is clearly outperforming and max does the worst. Next slide, please. However, as I discussed before, while talking about Sharpe ratio, just looking at returns doesn't tell the complete story. So for instance, if we look at the min volatility strategy, if we just look by returns, it ranks in the 3rd position. However, min volatility strategy is designed to pick stocks with low volatility. So the standard deviation of returns is pretty low. And as a result, it ends up having the highest Sharpe ratio. And can you go back, Jason? Also, next up, we have the max mean strategy, which has the highest return and the 2nd best Sharpe ratio. And for some perspective, around this time period, which we analyzed from 1970 to 2020, the rockstar investor was Warren Buffett, and his Sharpe ratio during this time was 0.76. So none of our strategy compares to what he did, but we are still able to outperform the market, which the Sharpe ratio of the market S&P is around 0.38, 0.39 during this period. So the min volatility strategy outperforms that, and max is around that.
Arshad, I would point out that you guys are outperforming the market when you can have a portfolio of only 20 or 30 stocks.
Mm-hmm.
If you were to try to do this with 100 or 500 stocks, it would be prohibitive. But the fact you're able to do it with a small, manageable number of stocks is what makes this so powerful. And it's not even very tricky science.
Yeah, it's a beautifully simple rule, and yeah.
But there's probably ETFs now for all of these techniques. The max median ETF, max mean ETF, or within the same family of different ones.
Yeah. Okay, so now I'll hand over to Keshwe, who will talk about forecasting the future returns.
Okay. So next, we will use time series model to forecast the returns. And before we forecast, I check the correlation by using ACF and PACF. So the left-hand side pictures is ACF. We can see the lags are significantly correlated. And for the right-hand side page is is for the residues, and we can see the ACF for the arrows is not significant correlated. And the QQ plot for the residues has fat tails. But for the Young box test, the p-value is very small. So we do reject the null hypothesis, which is the lags are not correlated. So we can conclude that the lags are correlated. Next, please. So next, based on the returns before 2015, we have the right-hand side picture, which is the time series model. We can see is the forecasting after 2015, and we're using model ARIMA 0 to 1. And the left-hand side figures is I combine the two graphs together. So the red line is confidence interval for the forecast values. So the values should be in that range. So the blue circle and blue line is our forecast return. So we can see is very match for the actual return for the actual returns. Next, please. So this one is the forecast for SP 500. We can see the one step ahead, which is 2021. The return value is 102, and also this the 5 step ahead, which is the next 5 years, by using ARIMA 2 to 1. Next. Then I will apply this time series model on all those 4 strategies. For max medium, I using ARIMA 2 to 1 to forecast the next 1 year and next 5 years. So these are the values. Next. And next is max strategies, and those are 1 year and 5 years forecast values. Next. And max mean, we can see the max mean so far has the highest return value, which is 673 for 2021. Okay, next. And the next one is minimum volatility strategies. We have 350 returns on 2021. Next. I put all those values in the table so we can see it very clearly that the max mean strategies have the highest return for the next 5 years. And also max mean strategies have the highest change percentage, which is positive 31%. And the max on the other hand have the lowest forecasted returns is about $40, and the lowest change percentage, which is 7%. Next.
So after talking about 5 years predictions, we want to narrow the scope of our predictions to monthly return. So we made a 1 step ahead forecast for the January 2021 for the 4 strategies, which were max median, max mean, max, and minimum volatility, by using the monthly data from 2019 to 2020. And the sizes of the portfolio we used were the ones that performed the best from our previous back testing results. So we can see that, so the first one we see is the max median strategy with size 10. And the computer chose ARIMA 010 for us to fit the model. And the monthly terminal return we predict for January 2021 is 1.56. It means that if you have $1 in 2019 using this strategy, you will have $1.56 in January 2021 with this strategy. Next, please. So now we are seeing max mean strategy with size 30. Again, the computer chose ARIMA 010 again, probably because the pattern of the data looks really similar to the previous one. And the forecast terminal return here is 1.65. Next one, please. So now we are seeing a max strategy with size 30, and the forecast terminal return is 1.52. Next one, please. So now we are seeing the minimum volatility strategy with size 20, and the forecast terminal return is 1.31. And you may notice that the terminal return for the last couple of years in 2020 were decreasing. And next one, please. So to summarize, we found that one step ahead monthly return forecast for the max min size 30 strategy has the highest monthly return, and minimum volatility with size 20 has the lowest return, which is different from our back testing results. Our back testing results shows that max strategy has the lowest return, but here for the one step ahead monthly ahead forecast, the minimum volatility has the lowest. And it is because the terminal return for the last couple of months in 2020 were decreasing, and thus give us a lower terminal return forecast. And I will pass it on to Jason.
So in conclusion, we saw that the max mean strategy had the highest terminal return. We also saw that the highest change percentage was for next 5 years. The max was the lowest terminal return for the lowest percentage for the 5 years, and was that for the mean max mean size strategy, it was predicted to be the highest monthly return for January 2021, and we saw that the minimum volatility size 20 had the lowest predicted monthly return for January 2021. And these are references that we used. So.
And so how did we do on January 2021?
Yeah, so for the forecast, we like the max mean strategy with size 30 has the best predicted monthly return, but we haven't really looked into the real data because it is not on CRISP yet, but it'd be interesting if we look at it.
That's a good point. We can look at that next year.
Yeah. And
that's a good point. Any questions for this team? This was a very interesting approach.
I have a question for you, Professor. Something I'm curious about. Like, is there any metric which like looks at like how predictable a strategy is?
That's what we're all over in this. That's what we've been looking at lately is analyzing trading strategies. So right now we're sort of in a data collection process, and that's a very ripe area for research to induce what the trading strategy is from the performance results. It's really hard because people generally don't post their results if they're not favorable.
Mm-hmm. Yeah.
So you really can't get an unbiased evaluation of a strategy because you don't really have the data for it. It's a very interesting problem, and I've started on it. I don't know if I'm going to finish it. But yeah, it's all about statistically evaluating strategies.
Yeah,
so that's why I'm so glad you had the S&P 500 in there. That was good.
Mm-hmm. Yeah, it would be cool to have something like that.
Well, I'm going to make a note. Any other questions for this group? Well, I think you guys did an absolutely fantastic job. So thank you very much. I'm going to be going back and looking at this presentation because I need some of the stuff in there. I hope they posted their code. Okay, group number 3. This is Giovanni and Isaac Cha and Brandon Guan and Moses Glickman and Sarah and Gio Pecchio. And Gio has started us out. Okay. Well, soybeans have not been going down, have they?
No, they have not. So hello. I'm group 3, myself, Moses, Sarah, Isaac, Gio, and Brandon. For our project, we were looking if weather could be a predictor for soybeans prices. So we're going to walk through our agenda here. First, we're going to start off with an introduction. We're going to look at the soybeans market globally and also more specifically as in the US. Take a look at prices over time and where are the main producers, and then also walk through our project goals that we were trying to find here. Next, we'll walk through the methodology, a little bit of our data gathering and what models we use to test the data and how we were going to accomplish that. Then we'll walk through the analysis of those results, look at some of our regressions, as well as some other results from our method that we use to test. And then we'll finish it off with a just brief conclusion, just some final notes about what we found. So I'll pass it off to Sarah for the introduction.
Yeah, so as Gio said, before we dive into our methodology and analysis, we'll give you a bit of a background on soybean production in the United States. So during 1960s, United States became a world soybean producer and began exporting large quantities of soybeans due to the rapid increase in the worldwide demand for animal protein. It remained world-leading soybean producer for a long time, but in 2020, so recently, it became overcome by Brazil, so now it's the second largest soybean producer. Just to get sense of its economic significance, in 2020, total production of soybeans in the United States was around 4 million bushels, and with the total value of $46 billion. So for the purpose of our project, we had to limit the area for which we were going to analyze the weather. And so we were looking at the primary growing areas of soybeans in the United States. And as you can see on this graph, the top producing states are Iowa, Illinois, Minnesota, Indiana, and Nebraska. Next slide. So as you can imagine, the United States is one of the biggest exporters of soybeans as well. Almost 50% of total soybeans production is being exported, and the top exporting destinations are China, then European Union, Mexico, and Egypt. Speaking about the international trade, under North American Free Trade Agreement in 1994, soybeans exports to Mexico and to Canada doubled with the elimination of all tariff and non-tariff barriers for trade. And the US-Mexico-Canada Agreement in 2020 replaced its precedent from 1994, sustaining the growth of soybeans exports. We could also not go and miss to mention the trade war between the US and China that greatly affected the soybean exports, since China levied a 25% import tariff on soybeans in 2018. So on the next slide, here on the right, we can actually see how the prices of soybeans were affected by the 2018 trade war. But we can also see some recent increasing trend of soybean prices. The main reasons are said to be the strong global demand, surprisingly from China, as well as the limited production in other countries since South America saw weather disruptions throughout the year. So speaking about the demand and supply, since 97% of soybeans produced are used to feed animals whose meat is then sold to consumers, soybeans are fundamental part to the food supply chain, and therefore this commodity has high level and stable demand. Therefore, for the purpose of our project, we can safely assume that the supply of soybeans is the main driver of price changes. Since the temperature is the main factor that influences the soybean yields, we chose to focus on that aspect of weather in order to predict the prices. So the goal of our project is to investigate the relationship between the temperature in the main soybean growing areas and soybean future prices. And we're going to do so by predicting the seasonal soybean prices based on the seasonal weather forecasts in the primary growing areas. So now I'm gonna let Gio tell you a little bit more about our methodology.
Thank you, Sarah. Next slide, please. When we look at the data that we had to use, we had two main data points that we looked at. One was the soybean prices, and to get this data, we looked at the daily soybean future contracts. And then the other one was the weather data. The issue with the weather is that we couldn't combine multiple locations and just get like an average temperature. So we looked at the main hub for soybean production in America, and that happened to be Cedar Rapids in Iowa. And we got the daily temperature values in Cedar Rapids, Iowa, through the National Center for Environmental Information. Next slide, please. What we did with the temperatures and what we found out through analyzing the temperatures is that to achieve optimal growth for soybeans, you have to have around the mid 80s Fahrenheit during the daytime and 72 Fahrenheit during the nighttime. However, if you dip below 68 Fahrenheit or if you go above 104 Fahrenheit, this would actually have the opposite effect in soybeans growth and stunt that growth specifically. Also, if the daily temperatures, the daytime temperatures go above 99 Fahrenheit, this will severely impact the formation of the pods for soybeans. And then during the nighttime, the same would happen if the temperatures are significantly less or less than 60 Fahrenheit. Now I'll pass it on to Mo to talk about how we treated the temperature data.
Right. So as mentioned, we took that data from the NCEI from Cedar Rapids, Iowa. The NCEI has a station there releasing data. We're able to get the temperature max and temperature minimum. Quick note on coverage. The coverage was approximately 100%, about 99.9%. There were about 11 days missing over the entire 50-year horizon. What I did was I just assumed that for those 11 days, the temperature was identical to the previous temperature. So that's how we handle coverage on the Tmax Tmin. Temperature obviously displays a clear seasonal trend. We'll show the charts on that in a moment. We mainly cared about our maximum temperature rising above 99, which is when we started seeing some severe problems in soybean growth, as mentioned, and when the temperature minimum declined below 60. We also added a binary variable for sub-freezing because we figured that at extreme cold temperatures, the soybeans would be impacted more negatively than at, say, below 60-degree temperatures. For all of those, we then adjusted incidence, assuming that, hey, prior day's weather has an effect on the current day's weather and is likely priced in. So we took that week's that week's temperature, got an ARIMA 700 model for forecasting each day's temperature, assuming that was what was priced into the model. And then we subtracted that in order to take the unexpected component of the weather. So we got an adjusted likelihood of heat based on, we got an adjusted likelihood of heat and an adjusted likelihood of below 60-degree temperature and an adjusted likelihood of below 32-degree temperature. We also include, unfortunately, we were not able to use a SARIMA because this was daily data, and a SARIMA would require a 365 lags, which is more than ours packages were able to handle. So what we did was we instead yanked the month from that and included the dummy variables in the final regression. For each season, we omitted fall, which was the September to November range, in order to avoid multicollinearity. So now let's talk about why we chose that AR7 model. Looking at the ACFs for minimum temperature and the ACFs for maximum temperature in time series form, you'll see that the PACFs for lags 1 to 7 are significantly above significant. I'm sorry, there is significant autocorrelation. They appear to add it appears to really add something to the model to put in every day between day 1 and day 7 into the model there. And that's true for both the minimum temperature and the maximum temperature series. So that's how we justified using an AR7 instead of a lower number of lags, because the PACF was significantly above that blue line. So now going on to the weather charts, the two weather charts, max and Tmin. There's some seasonality in there that's quite obvious, like it goes up and down rather like a barcode. So you can see the difference between the summer and winter quite markedly there. For the weather charts from left, that is the binary variable for, hey, our temperature is above 99 degrees. For that one, the seasonality isn't terribly obvious, although as you'll see, that did only occur essentially in the summer months. There was only one value for in the fall, one value for in the winter. For less than or equal to 60 degrees, you can actually see seasonality by looking at that bottom line and looking at the regularly spaced holes in that bottom line, and that below 60-degree temperatures did not occur in the summers, which was when those absences were there. And looking at below or equal to 32, again, you see that barcode thing. Those 32 days are disproportionately concentrated on an annual basis, usually in the winter time. So now let's look a little bit at our price data, essentially how we dealt with that. We were interested in soybean price movement. So we looked at the price differences between trading days. As you can see, there is very significant clumping, much as how Mandelbrot said that many markets can be modeled as, one day's variance led to another day's rapid price swings. That is very true in the soybean market. Times of high activity appear to be disproportionately followed by times of additional high activity, and we'll look at the ACFs for that. As you can see, our ACFs for the actual value of price swings, like the actual price shifts, there is no real significance there, right? Like soybeans are basically an efficient market, and that your previous day's price swings don't appear to predict the absolute value of the future day's price swings. But when you take the magnitude of price swings, you have a much different picture, and that would be the ACF on the right there. You see that there's very, very significant autocorrelation between one day's magnitude of price swings and another day's magnitude. You see that at the PACF, you see the lags are positive for quite a long time, meaning that even many days down the line, one day's rapid price swing increases the likelihood of another day's rapid price swing. So that's really indicative of what Mandelbrot said about chaotic periods begetting other chaotic periods disproportionately. Now let's talk about the way we did our regression design. As mentioned, we used that ARMA 700 model to predict the likelihood of the maximum temperature and minimum temperature hitting some preset thresholds. And then we used the residuals of that as our adjusted temperature results. And that was to avoid incorporating priced in data, because look, if the whole week is freezing, then another day of freezing temperatures is going to have a much less severe effect on soybean temperatures, because the increased likelihood of that is priced into soybean prices. We then regressed those price differences on those adjusted temperature coefficients and 3 seasonal dummies.
Okay, yeah, so for our regression results, as you can see here, rather interestingly, the only statistically significant result was for our heat variable for when temperatures rose above 99. Our chilly and cold weather variables were actually not statistically significant. And, so the only major predictor of, a significant fall in soybean futures prices would be there was an unexpected day, of high heat above 99. And of course, as Mo explained, we controlled for expectations based on previous weeks already. So this isn't the case of, weather shocks. Next slide. Yeah, so neither unexpected cold nor unexpected chilly weather was significant, like I just said. Even when we changed the cold threshold, it still wasn't significant. So heat was the only strong predictor of changes.
Yeah, so going off of that, on the chart on the left, we see that where we see increases in price in times of high heat based on the specific threshold for high heat. One thing to note is that this chart does not show marginal projected increases in price. For the chart on the right, we see that these results are significant at around 99 Fahrenheit and above 104. These results were obviously adjusted for season and the past week's temperatures as well. This next chart focuses on the cooler side, specifically from -20 to 10 Fahrenheit. And we see that cold snaps are not significant at any of these temperature thresholds for price changes. This could be due to the fact that soybeans are more resilient to cold weather, as is Iowa's infrastructure. And this makes sense since cold snaps occur much more frequently than heat waves, and as a result, the infrastructure to combat heat waves in Iowa is less robust.
So I'll just wrap it up with a small conclusion here and some final notes. as we mentioned, high heat ranges above 98, 99 degrees are associated with significant increases in the prices. The predicted increase is actually around 23 cents, which is extremely high. And this is even after accounting for expected seasonal effects or past week's prices. We did actually have a very low R squared value, but we think this is reflective of how infrequently those extremely high heat days happen. And like I said, seasons didn't seem to affect prices, neither did just chilly or cold days. And this could be because the high temperatures are much more harmful to the crop and to various costs that would increase that. So that's all we had. Thank you. Is there any questions?
Boy, that was nice. I wish I could ask a bunch of questions as to some of the rest of you, but I think we have to move on because we are running out of time. So if Alonso's group could come up and talk to us about Bitcoin and equities, and Deleka and Marcus and Dan and Jackson.
All right, I'll go ahead and start. Hello, everyone. My name is Jackson Savage. Deleka.
I see your screen.
I'm Deleka.
I hear your
Alonso.
voice.
I'm Dan.
I'm Marcus Martinez.
And today we're going to be looking at how crypto stocks and the S&P 500 relate. And so quick agenda, we're going to first go over a quick explanation of what crypto is, then on to our data sourcing and methodology, and then we'll go on to analysis of price comparisons, data analysis, correlation analysis, and on to our conclusion. So quick overview of crypto. It's essentially a digital currency derived from blockchain technology, and it's used as like a decentralized technology that manages and records different transactions. Right now, there's around 6,700 coins traded on the public markets, and it estimates to about 2.2 trillion in market cap, and 55% of that is comprised of Bitcoin. So some of the pros of Bitcoin is that it's considered more secure than traditional forms of payments. There's also no inflation because there's a set number of coins out there. It's accessible to all investors, from the institutional investors to general investors like you and me. It's also highly liquid because it's traded 24/7. And then for some of the cons is the fact that it's a currency, it generates no cash flows, and its value is strictly driven by demand. So in order for someone to profit, you have to find someone who's willing to pay more for the currency than you did previously. And that leads to a circulation paradox where if people think Bitcoin might be worth a lot more in the future, people now are less likely to spend and circulate the tokens, therefore making them less viable as a currency. And there's also subject to pretty significant volatility, which we'll get into later. There's some regulatory uncertainty given that it's such a new technology and there's no backing behind them. So starting with Bitcoin, we use 3 different coins for our project: Bitcoin, Litecoin, and Ethereum. So starting with Bitcoin, it was the first coin introduced back in 2008 with the goal to be a decentralized public ledger of transactions. The first transaction occurred in 2010, and someone paid 10,000 Bitcoin for $25 worth of pizza, and some significant time period. So in 2011, it hit $1 for the first time, $1,000 in 2013, and up to $20,000 in 2017. And then around the end of 2017, beginning of 2018, there was a big initial coin offering craze where there was lots of new coins being introduced onto the market. And that ultimately led to a pretty steep crash in Bitcoin of around 65%. And around that crash, there was institutional investor apathy, large uncertainty regarding regulatory circumstances. Like the SEC refused to approve a Bitcoin ETF around that time. And there's also a pretty significant $50 million hack, and that kind of led to normalized hacking. And now in 2021, the price is around $50,000, and it has about $1 trillion in market cap. And so now on to Ethereum. So Ethereum was introduced in 2013. It was actually crowdfunded using Bitcoin's network and ultimately became live in 2015. Began trading at around $2, but in 2016, there was a significant $50 million hack, which caused the price to drop from around $16 all the way down to $6. And in 2017 and the beginning of 2018, during that initial coin offering craze, most of the transaction had to occur through Ethereum. So if you wanted to participate in one of these ICOs, you had to buy Ethereum first. And that, of course, led to its price high of $1,400 in 2018. And today it has the second largest market cap of all the cryptos. Now on to the last coin, Litecoin. It was introduced in 2011 by a Google employee with its goal to be kind of a more rapid transaction peer-to-peer currency. And it was derived using Bitcoin's code and had 4 times faster block generation, which made it be a lot more popular for amateur miners because it didn't require as much like physical hardware. There were several upgrades into the code, especially in 2017, and that kind of caused the price to rise from $3 all the way up to $300. And today it's currently the 10th largest in market cap. And for reference, Dogecoin, the meme coin, is currently at the 7th largest position. And so now I'll hand it over to Alonso for our data sourcing and methodology.
Yeah, so we utilize 2 major resources for data collection: the Words website, specifically the CRIS database, and a website called Crypto Data Download. We've used Words extensively in this class, so all of us should be familiar with it. But as for Crypto Data Download, this is essentially a database of historical cryptocurrency data. They provide historical data for the most prominent crypto coins like Litecoin, Bitcoin, and Ethereum, and for some of the most prominent cryptocurrency exchanges like Coinbase, Binance, and Gemini. Unfortunately, the data for Coinbase, which is what I would say the most popular exchange in the United States, especially now that they went public recently, was restricted by a paywall. So we settled for data for Gemini, which is still a very prominent exchange. From Crypto Data Download, we pulled daily open, high, low, close price info for each coin. The time period of this data differed based on the specific coin. For Bitcoin, we were able to gather data since 2015 to 2020, but for Ethereum and Litecoin, we were only able to start from 2016 and 2018 respectively. From CRIS, we downloaded daily return info for the S&P 500 index from 2015 onwards, including value-weighted and equal-weighted with and without dividends. So you can go on to, yep. So after getting our data, we noticed one major difference between cryptocurrencies and stocks. Crypto never stops. Unlike trading stocks, there are no set trading hours or predetermined trading days. A person can trade crypto 24 hours a day, 7 days a week for 365 days a year. On the other hand, the trading market for the S&P does close. Therefore, we decided to filter our cryptocurrency data to only include info from days that the S&P was active. So we cut out a lot of data on the crypto side. We decided on this because we wanted to establish a better relationship between the 2 data sets since we are comparing one another, and we wanted the days to sync up on either side since our calculation requires so. However, this does have some consequences. Namely, we are restricting our knowledge of the crypto and could be missing out on key info. For example, if there are some big moves on the weekend or during a holiday for Bitcoin, our data wouldn't reflect that since the S&P is not active during those times. Another thing to consider regarding our data is that it is relatively limited compared to what we've worked with before in this class. Only data for Bitcoin stretches back to 2015, which is itself not that long ago. But while this may seem like a problem, we believe it's not as impactful as one may think. Cryptocurrency was very niche in its infancy and only has started to gain traction and legitimacy very recently. So looking at info that far back won't have much impact on our findings. Instead, we believe it'll only help further establish a trend that we already noticed in our analysis. Despite these 2 concerns, we had excellent coverage in our data, so it helps reassure us that what we're working with makes sense. And so I'll hand it over to Dan.
Yeah, so once we had gathered all the data and filtered it in the ways that we previously mentioned, we needed to find a way to compare the cryptocurrency data with itself and with the S&P 500 data. So we decided to focus on 2 main aspects: the beta coefficient to identify differences in volatility, and then the general correlation coefficient to see if we could identify any trends or patterns between any of the 3 cryptos in the S&P or between the cryptos themselves. So in order to calculate these coefficients, we had to do some preliminary calculations, finding things like mean yearly returns, daily deviations, yearly standard deviation, and variance. And with regards to beta, generally if something has a beta coefficient of greater than 1, it would indicate that it moves with more volatility than what it's being compared to, while coefficient less than 1 would indicate it moves with less volatility. And I say generally because there are cases where context matters, and this will definitely be demonstrated with our results. More specifically, if we look at the formula, the numerator takes covariance is divided by variance. So in our case, this would be the covariance between one of the three cryptocurrencies and the S&P 500. With regards to assets, this covariance will generally measure the relationship between direction and price movement. And the covariances that were calculated between the cryptos and S&P 500 were extremely low. So like almost 100,000th of a decimal place in some cases. So like when you're finding the beta of something like Apple stock in comparison to the S&P, the covariance becomes more reasonable and can therefore actually provide some decent insight. But since our covariance was extremely low from the start, the beta coefficients were going to be low no matter what, which means our base results may indicate that cryptos were less volatile than they actually may be. So this covariance was also a good initial indication that the correlation was going to be low. As you can see, the numerator for correlation coefficient in the formula is covariance, and that's divided by the product of standard deviations. And so these results, the results of the calculations were not 100% clear in regards to those sort of flaws mentioned earlier, but it was enough for us to make some interesting conclusions.
So now we're just going to go into some of the price comparisons across. So Jackson sort of talked about for each coin some of the main trends and important events, but now we're just going to compare all the coins and the S&P across their prices. So this first slide is for the S&P on the left. We have from 2015 to 2020. You can kind of see, I think we're all familiar with this graph at this point. And then in the top right, we have Bitcoin. So I want to emphasize that these three plots are for different time periods because it's for the life of the coin. So like Bitcoin is from 2015 to 2020. Ethereum is from 2016 to 2020, and Litecoin is from 2018 to 2020. But I thought it would be interesting to sort of see how the prices evolved over the period of the coin. And I think this also really shows that Bitcoin took a really long time to sort of gain traction, whereas Ethereum in the middle was a bit quicker, and then Litecoin was much quicker, where its two peers started at 0 for a long time, as it started off at like 60. Then over here, we have something called the OHLC average. So O is opening price, H is the high price, low price, and closing price for a given day. And we have the same exact plots, the same exact things. And I think this plot shows you that it is very similar to just the closing price, but we wanted to include our OHLC analysis as well. And then finally, for the price comparisons, we wanted to look at the closing price, directly comparing all of them. So what I did here was I made sure that all of them were for the same time period. So these are all from October 16th, 2018 to December 31st, 2020, and same with this plot over here. So you can see that the S&P just kind of does its own thing. And then these are the three coins up here on the top. So this plot shows you that Bitcoin in the red is just a lot more valuable than Ethereum and Litecoin, so it's kind of hard to see the comparisons. So in order to fix that problem, I scaled them. So I multiplied Litecoin by 100 and I multiplied Ethereum by 30 in the green. And you can see that all three are very different. They have their own volatilities and their own patterns, but they do sort of follow some similar trends, which we thought was interesting. Like at the time point 250, which would have been like mid 2019, they all sort of start to jump together. And that might be because of the news related to crypto or whatever it might be. And then they all kind of go down and then they all go up here. And then in the last year or so, they've all been going up a lot. So it is different from the S&P. I mean, they all dropped here and then they've been going up, but there are definitely some relationships that we saw between the coins.
All right. Now, in terms of correlation analysis, we are next slide, please, Delega. So we are comparing sort of each different coin for all its years. It was around to the S&P 500. I'll try and speed this up since we are already about 5 minutes over, and pretty much our sort of very base summary for correlation is that on average, Litecoin is the most correlated with the market, no matter what sort of like market weighted, equal weighted with and without dividends you look at. It's consistently more correlated, especially during COVID times, which is the year 2020. Next on to beta analysis. Can you go next slide, Delica, please? So we have that both market weighted and equal weighted, or both types of market weighted have the exact same results, while equal weighted have slightly different results. But again, pretty much a base summary is that Bitcoin is the most beta, which sort of makes sense since it's very volatile. And as we've said before, beta is typically measured volatility, but the prices don't follow each other in a very low core covariance. So the beta will never be high. That's why all the betas are low. But again, the betas are higher in 2020, particularly because it is during COVID. Now, sort of for like final summary results, we decided to use market weighted without dividends because I feel as if market weighted is the best way to compare to the S&P 500, and without dividends because cryptocurrencies don't have dividends that are currency. And we have that, again, correlation, the average correlation, the best is Litecoin, and its average correlation is 0.15. And for beta, it's Bitcoin, and its average beta is 0.08. Next, when we compare the cryptos to each other, Litecoin is the best correlation with Bitcoin with a correlation average of 0.873. And then for beta, it's also Litecoin. It's the most volatile relative to Bitcoin with a beta coefficient of 0.876. So it's still volatile, but not as volatile as Bitcoin. And then finally, for our conclusions, overall, like the year 2020 has the largest correlation between all cryptos and the S&P 500, and it has the largest betas. This is most likely due to COVID, and the markets all crash at the same time, make them all generally move down together. This is probably why I see that Litecoin is the highest correlation overall because it only has 3 years of data, one of which was during the COVID crash, while the others have 5 and 6 years, so they have twice as much data, and so the crash only had about half as much impact on them on average, or on its average. And then sort of, so that's why Litecoin is the most correlation with the markets. Beta, Bitcoin is the highest, which just makes sense because it's infamously high volatility. And then sort of generally in sort of like an other category, we disregard Litecoin because, as we said earlier, it only has half the data and it's most impacted by COVID. So we might say that Ethereum might be the safest coin as it is more correlated with S&P 500, and it is about half the volatility of Bitcoin. But if you want to look at diversification for a portfolio, we might recommend using Bitcoin because it is the highest beta and it's the most risk reward, and it also is the least amount of correlation with the S&P 500. So it might be a good thing to hold for, yeah. So any questions?
Would it have been possible to calibrate your stocks data if you were to string together some 24/7 index of different world indexes?
Oh, yeah.
And you could string together some kind of basic return thing from like 4 indexes around the world if you wanted to try the 24/7 stuff.
Just to compare 24/7 stocks.
Yeah, because you're just caring about the
crypto.
returns. You just care about the
Yeah.
returns. So those returns are all available in real time, I guess, or historically. I mean, someone you have to hire a data person to pull it together, but that's one thing you could do. I was very happy with this. This is the kind of thing I've been looking for a long time, and I appreciate it. Well, if there are no more comments, I'd like to thank everybody for your attention. Oh, I tell you what, when Kashu's clock says 25 till, I know we're late. So I'm going to thank you for your attention and for taking the time to come to this class, and hope you got something out of it, and keep in touch if you have any questions, and we'll see you next time. Take care.